Welcome to the Accounting Desk. Today you'll discover how Ipsas 16 shapes the way public sector accountants manage investment property. Have you ever wondered how transparent property accounting can empower your financial decisions? Over the next 10 minutes, we will break down Ipsas 16 into clear, manageable segments that cover its objective, definitions, measurement criteria, subsequent measurement models, transfers and disposals, and required disclosures. By the end of this session, you will have a strong grasp of how this standard not only ensures transparency, but also boosts the reliability of public sector reports. Let's begin our journey by exploring the objective and scope of Ipsas 16. The core aim of this standard is to prescribe the accounting treatment for investment property. In practice, what does that mean? It means that every property held to earn rental income or for capital appreciation must be accounted for meticulously. You need to recognize it on the balance sheet, measure it reliably, and disclose its key details so that stakeholders fully understand the entity's fiscal health. Ipsas 16 is designed to bring consistency and transparency into an area where uncertainties could otherwise prevail. Consider this: if you manage a portfolio that includes commercial real estate or land simply held for its increasing value, Ipsas 16 acts as your reliable guidepost. It applies to land or buildings that are not used for day-to-day operations, but to generate returns. Specifically, you'll find that this standard does not extend to property that is actively used in public service delivery, nor does it cover property held for immediate sale. This distinction is powerful. It ensures that the financial statements focus on properties intended to yield longer-term benefits, rather than operational facilities or inventory. Now let's dive deeper into what exactly constitutes an investment property under Ipsas 16. Investment property includes both land and buildings held to earn rents or to appreciate in value over time. Imagine a government office building that is leased out to private companies, or picture a parcel of land held with the hope that its value will rise significantly in the coming years. These are prime examples of what Ipsas 16 intends to capture. It is important to note that not every building qualifies. For instance, if a structure is primarily used for government offices, military barracks, or is under construction for future internal use, it does not satisfy the criteria for investment property. This clear distinction is crucial for ensuring that you categorize properties correctly and maintain the integrity of the financial reports. Understanding this definition not only aids in proper categorization, but also paves the way for recognizing the property in your accounts. Recognition of an investment property under Ipsas 16 depends on one simple yet essential principle. It is recognized when it is probable that future economic benefits will flow to the entity, and when its cost can be measured reliably. This means that if you are holding a piece of land or a building that has a good chance of generating rental income, or if the property's market expects a reliable increase in value, then it qualifies. Moreover, the cost should include not only the purchase price, but also any directly attributable costs, like legal fees and property taxes paid at the time of acquisition. Moving forward, let's reflect on the initial measurement of the investment property. When you first recognize an investment property, you measure it at cost. Cost here is not a simple number. It involves the purchase price, plus any directly attributable expenses incurred to bring the property to a condition where it can be rented out or maintain its investment potential. For many public sector entities, this step is foundational. It sets the stage for later comparisons and ensures that the financial statements start on a solid footing. At this point, a quick thought for you. Imagine managing a portfolio where every property is accurately recorded. That clarity drives better financial decisions and reflects the entity's true financial position. It's not just a matter of compliance, it's a tool for transparent governance. Next, we tackle one of the essential features of Ipsas 16, the subsequent measurement models. After the initial measurement at cost, investment properties must be revalued over time. Here, you face a choice between two measurement models: the fair value model and the cost model. The fair value model is often favored when a reliable measurement is available. Under this model, you measure the property at its current market value, and any changes in valuation, whether gains or losses, are reflected directly in the surplus or deficit. This method presents a dynamic view of an entity's assets, capturing market fluctuations as they happen. In contrast, the cost model involves measuring the property at its historic cost, less accumulated depreciation, and any impairment losses. This model is simpler in some respects, as it does not require frequent revaluation. However, for public sector entities where reliability and relevance of current market conditions are paramount, the fair value model is frequently the preferred option. Sometimes, the choice may be dictated by the ability to reliably determine fair value. When such determination is challenging, the cost model provides a viable alternative. It is important to note that once you select your subsequent measurement model, consistency is key. Changing from one model to the other is permitted only if it enhances the relevance and reliability of the financial statements. Consider this directive as a call for careful evaluation. A model switch should never be made on a whim. It must be methodically justified to maintain transparency for all stakeholders. Let's transition now to discussing transfers and disposals. In the life cycle of any investment property, changes in use or disposition can occur. Transferring a property from owner-occupied status to an investment classification, or vice versa, requires careful reclassification. When such a transfer happens, the financial treatment must reflect the new use, ensuring that reclassification is done in line with Ipsas standards. For instance, if a building that was once used for public service is now leased out, it must transition into being recognized as an investment property. Conversely, if an investment property becomes part of operational use, the rules align with those used in Ipsas 17 for owner-occupied properties. These transitions are not merely administrative adjustments, they reflect real shifts in how the asset generates economic benefits. Similarly, the disposal of an investment property requires diligent handling. When you sell or dispose of a property, you must remove it from the books. Any gain or loss from this disposal is immediately recognized in the surplus or deficit, ensuring that the financial outcomes of the transaction are clear. Whether the property has appreciated or depreciated, its removal from your accounting records must be transparent. This procedure not only reinforces the integrity of the financial statements, but also provides an accurate picture of the entity's performance over time. Before we wrap up, one more element remains: disclosures. Disclosures are a window into the application of Ipsas 16. You must include comprehensive details that explain the measurement model used, be it fair value or cost. Disclosures reveal the criteria for classifying property, the methods and assumptions applied to determine fair value, and the financial performance of the investment property. For public sector reporting, such information enriches the narrative and reassures stakeholders about the rigorous standards at work. In practice, you might use tables or charts to visually represent these disclosures, simplifying complex data into an accessible format. Visual aids like sample disclosure tables are particularly useful in presentations and discussions. Now let's take a brief pause and consider why you are learning this. Imagine a scenario in which you are responsible for preparing financial statements for a public entity. Every decision, from classification to measurement, impacts the reliability of the reports you produce. You want to instill confidence in your data. Ipsas 16 gives you the tools to do that, providing clear, consistent guidelines that ultimately lead to better decision-making. That assurance is the heart of our session, the assurance of transparency in public sector accounting. Let's now recap the key points we've discussed. First, remember that Ipsas 16 prescribes the accounting treatment for investment property, ensuring transparency and reliability in your financial statements. It applies only to properties held for rental income or capital appreciation, and not to properties used for government operations or those held for sale. Investment property is initially measured at cost, which includes the purchase price along with all directly attributable expenses. As time passes, you have the option to adopt a fair value model, which captures current market conditions, or stick with a cost model that adjusts for depreciation and impairment. Keep in mind that consistency in applying the chosen model is essential. If a property's use changes, you must carefully reclassify it, ensuring the accounting treatment aligns with the new role. When disposing of an asset, The gain or loss arising from the disposal is immediately recognized, ensuring that the financial statements remain accurate and reflective of true economic performance. Lastly, thorough disclosures are a vital part of Ipsas 16. They provide detailed insights into the measurement models, classification criteria, and the overall financial performance of the investment property portfolio. You now have a clear picture of Ipsas 16 and its framework for investment property accounting. By understanding these concepts, you are better prepared to manage complex portfolios and navigate the intricacies of public sector reporting. Every public sector accountant should use these guidelines to not only meet compliance requirements, but also elevate the reliability of financial statements. This session has aimed to resolve the complexities of Ipsas 16 by breaking it down into digestible segments. Think about the clarity you gain when every element, from objective formulation and property classification to valuation and disclosure, is consistently applied. Your enhanced understanding will help you make informed decisions and lead to more transparent and robust reporting practices. Before we end our session, I'd like to leave you with this final thought. Consistency, transparency, and precise measurement are the pillars of sound public sector accounting. Embracing Ipsas 16 not only complies with international standards, but also builds trust and credibility in financial reporting. As you apply these principles, remember that the detail you capture today will lay the foundation for sound financial strategies tomorrow. Thank you for joining us on this in-depth exploration of Ipsas 16 investment property. If you found these insights valuable and want to dive even deeper into accounting standards, please like and subscribe for more expert walkthroughs. And stay tuned, because our next session will cover Ipsas 17, where we explore the intricacies of property, plant, and equipment. Your journey to mastering public sector accounting continues here at the Accounting Desk. For more clear accounting insights, like and subscribe now.